of these things. Steve, have you seen anything in earnings recently that's caught your eye?
Lots, but I think the only one we've really got time for is Adyen. As a company, I don't think we spoke about too much on the podcast. I'm not sure how much we've covered it, really, but we'll just quickly go through what their earnings are. So they're a high margin, profitable Dutch fintech slash payment provider. It's a pretty expensive looking stock. It has 59% EBITDA margins and converts 87% of that EBITDA into free cash flow. So that puts it in the top 10 businesses in the world for this metric, and is only just behind Visa. So quite interesting. Opening on Thursday, it was down about 12%, and it was only on a small miss. So I've got the figures here for you. So payment volume was up 60%. You've got to think that's on really, really tough comps. And they've still grown payment volume by 60%. So that trickles down to net revenue being up 37%, EBITDA up 31%, net income up 38%. The CapEx maintained at about 5% of net revenue, which is that's a management target. Margin 59%, and actually a 2% fall from last year, and they wanted 65% margins. So that's not a good sign to see. 1% of it was actually attributable to hiring and charity. So headcount grew by about 15% this year. So when tech are sacking people, Adyen are sucking these people up. They also supported UNHCR's fundraising and relief work in Ukraine. They matched all donations that came in from their shoppers, and they absorbed all the transaction costs. So, they deserve a little bit of applause for that. I think that's a really nice thing to do. Net revenue grew in every region, Steve. EMEA was up 30%, North America 52%, Asia Pacific up 53%, Latin America plus 25%. So all of that sounds great. So why was it down 12%? They missed on revenue and EBITDA, and this is all caused by something called the take rate. So the take rate is the fees that Adyen charges when people use its service, and these have actually fallen for the second half in a row. So they were at about 20.6 basis points, and they're now all the way down at 17.6 basis points, and that's quite alarming, really, for a company like that. You don't want to see that happening. You want to see take rate going up as they, offer more and more value to the customers. They can charge them more and more. So I was looking for an explanation, and I've found it for you. So they offer a tiered take rate system now. They didn't do this before. It was just a one flat fee, and now it's tiered. So the more you use the system, the less you pay back to Adyen. So this is good and bad, depending on what your viewpoint is. So Adyen has always been viewed as quite an expensive payment platform processor. So this scheme encourages larger customers onto the platform. It reduces prices for large customers already on the platform, incentivizing them to stay. And we're actually seeing signs that that's happening. Just in the last half, they've added Samsung, Indeed, Shopee, Monday.com, Dior, Uniqlo, Iberostar, the hotel chain, just in this half. And I mean, we're adding those to names like Microsoft, Overmatch, Nike, Spotify, eBay. So yeah, it's definitely working. So I guess the unfortunate thing is these are linked. So if the take rate is down, revenue has to be down, and EBITDA has to be down. Even if you're growing, because the take rate is depleting faster than that, they're actually increasing revenue. So this could get a little bit worse as Adyen continues to attract big customers and doesn't attract so many smaller customers. I thought it was still a stellar report, Steve. It's still an expensive kind of stock. I'm not in a rush to add to this stock. It's one that's in my portfolio, but did you have any thoughts?
I have two thoughts for what it's worth. One is that, you aren't in a rush to add to this stock. I wonder whether you should have been earlier today. Have you seen what it's done?
Yes, all the way back, isn't it? Yeah.
Almost all the way back, yeah. So it's now down about 3% and a bit. You pointed out correctly that it came down about 10% after those things, but it looked like an expensive stock, and it sort of still does look like an expensive stock if you factor in some slight bad news, and actually now not much of a decrease in price for what that's worth. But I'm not particularly a growth investor, or I don't label myself as such. I don't really label myself as anything, but if I were a growth kind of investor, or if I labeled myself as such, this is the kind of thing I would want to be owning. Stuff is growing, and stuff is growing quickly, and I get that there's a sort of take rate issue of a sort there. It looks like an expensive stock, and when I hear payment processors, I start thinking of all kinds of things. I think of sort of PayPal, and think of Square, and I sort of think of StoneCo, and I sort of think of Adyen, and these kind of things. And I sort of wonder, apart from geographically, sort of a couple of those are US-based, one of those is Amsterdam-based, I think, or Dutch-based anyway, and one of those is Latin America-based in Brazil. What sort of marks out the difference between Adyen, which looks like a really expensive stock at the moment, and StoneCo, which really doesn't look like a very expensive stock at the moment? Both sort of payment processors, clearly payment processors are a positive area to be in going forward. Why pick the expensive one here?
I think the idea here, the reason Adyen is so egregiously priced in comparison is a couple of things really. Is that currency risk is a really big thing. Inflation risk generally should be a massive thing. South America over Europe. And the other thing as well is that StoneCo has a bit of a credit risk as well, which Adyen is not necessarily as exposed to. So just general thoughts. They're scrapping over different subsections of business too. So I think StoneCo and, Melly to a degree, are products of their environment. So they're South American fintechs built for the exacting needs of South America and sort of more Latin America, I guess, more broadly. Whereas Adyen is different. It's built for it to be almost like a global solution. And it wants to branch out into more financial offerings, and it's doing this. So at IPO, this was literally an online payments platform, but now it can handle online and offline payments. It can help with financial compliance. It can help with customer onboarding. It can help detect and prevent fraud, which are all areas which are adding little bits of extra value. Something that StoneCo and Melly both can do to some degree, but not to the scale that Adyen does. The reason I think it's so expensive is because people kind of think that they've missed out on Visa and MasterCard, and they see that Adyen is basically branching out into be this big sort of financial monster with similar kind of margins, and it's nowhere near the kind of valuations that those two companies are at, and thinking, well, I've got to have me some of that no matter what the price is, because it doesn't really matter, because in 5 years' time it'll probably be treble the size of business at the rate it's growing. And to be fair to them, they've not been wrong so far. Adyen is growing like a weed. One of the things I would point out, though, just before we do shuffle on, is that credit, where credit's due to StoneCo, Mercado Libre, dLocal, and even PagSeguro, they're all proving to be very, very tough competition. I mean, if you flick back up to the net revenue growing, net revenue in Europe was plus 30, North America plus 52, Asia Pacific plus 53, but only plus 25 in Latin America. And when you compare that to the growth rates that these four companies are throwing out, that tells me that they're winning in Latin America, and that Adyen has even gone to the point of actually building a quarters, an area of business in Latin America to try and localize that service and compete with these guys. But they seem to be kicking ass at the moment.
Yeah, Adyen kind of first came onto your radar, and by extension my radar, because things that appear on yours sometimes then make their way onto mine. When it sort of transpired that eBay was starting to use them instead, or about to start using them instead of PayPal, right?
That's right. Yep.
Yeah, which is a really interesting kind of business to keep an eye on and have a look at. I still find it hard to kind of get there with. I have a lot more digging on that to do before I can get myself to kind of pay those multiples that they're interested in selling it at the moment. But it's one that goes on my list for if there was a massive crash, which I don't know. Based on what we were saying at the beginning, I guess there might be.